Social Responsibility in Financial Markets, Chapter 1, Lecture 5. Being socially responsible and showing ethical behavior within the corporate world has changed drastically, but bottom line is you have to really look at different policies that you adopt with your company and organization to operate in an ethical and responsible fashion. You want to maximize values in the market, attract capital, while still providing employment and offer benefits to society without sacrificing your profit. One thing as far as ethical behavior is concerned is to make sure that you avoid insider trading, which is having inside information about the company in relations to earnings or different things that they're doing and making a trade within that time frame to give yourself personal gain. Ethical behavior creates invaluable reputation if you follow it. It takes a really long time to build up a great reputation, but can only take a matter of a short amount of time to ruin one. Because of corporate fraud and things that existed in the 2000s, the Sarbanes-Oxley Act came into effect. And this act was basically a 5-member public company accounting oversight board that has a responsibility for auditing standards within companies, controlling the quality of audits, and setting rules and standards for the independence of the auditors. Major focus is to make sure that publicly traded corporations accurately present their assets, liabilities, and equity income on their financial statements. The role of financial markets, there are two specific markets within financial markets to remember. One is public financial markets, and those are markets that include national, state, and local governments. And the other one is corporate financial markets, where you can buy stocks such as Nike, Ford, and Amazon, or bonds through private companies. Other distinct parts of financial markets is domestic and international markets, and money and capital markets. Money markets deal with short-term securities that have a life of 1 year or less. Securities in these markets include commercial paper sold by corporations to finance daily operations, and certificate deposits with maturities less than 12 months sold by banks. The key with money markets is just 1 year or less. Capital markets are things that are 1 year or more. Long-term markets, I would say securities such as stock, government corporate bonds, but again, the key there with capital markets is 1 year or more. Allocation of capital in which market you participate in is also important. You have a primary market, which typically deals with a IPO or when a corporation uses the financial markets to raise new funds immediately. Secondary market is what most of us participate in that buy stocks or bonds, and that securities are bought and sold amongst investors. The prices keep changing continually, and financial managers are given a feedback about their firm's performance within secondary market. Restructuring. Restructuring is something that changes in the capital structure, liabilities, and equity on the balance sheet. It could be selling of low profit margin divisions with proceeds from the sale reinvested in better investment opportunities, and removal of current management team or large reductions in workforce. These are all examples of what restructuring can do. When a company restructures, it's not necessarily a bad thing, but it's always something to keep in mind whenever looking at your company, and it's a good strategy at times, and other times it's not so great of a strategy, such as in recent days JCPenney. Also includes mergers and acquisitions when through restructuring phase. We continually live in a global economy and an international economy in terms of financial markets. Won't get into too many details with that with this course. Just things to keep in mind with international financial markets is just allocation of capital and searching for lower cost sources of financing. The impact of international affairs and technology has resulted in the need for future financial managers. You do need to understand international capital flows, computerized electronic funds transfer systems, and foreign currency hedging strategies. Again, this course is not focusing on that, but those are good things as a manager you should know. And that concludes Chapter 1, Lecture 5. Please see an on-course and resources in Week 3, Chapter 2, Lecture 1, the income statement when it's released.